All right, today we're diving deep into a company that's sitting right at the epicenter of the AI build-out, Applied Digital. Now, they're not the ones actually coding the next big thing in AI. Instead, think of them as building the massive, power-hungry factories where that AI will be born, trained, and run. This is a story of absolutely explosive growth, huge amounts of capital, and a high-stakes race to build the plumbing for the next tech revolution. So let's break down how they're doing it and, maybe more importantly, what it's costing them.
And if you want to understand just how big they're thinking, all you have to do is read this quote from their CEO, Wes Cummins. He's not talking about some tiny little corner of the market here. He is positioning Applied Digital right in the middle of a tidal wave of spending from hyperscalers. You know, the giants like Amazon, Google, Microsoft. Their spending on just the basic infrastructure for AI is already over $400 billion a year, and he says it's speeding up. This really sets the stage for everything we're about to look at, a company taking a huge swing at a truly massive market.
So here's what we've got on tap for this breakdown. First, we'll get a handle on what Applied Digital actually does in this AI infrastructure gold rush. Then, we're going to decode their absolutely insane revenue growth. After that, we'll look at the price of that growth by digging into their profitability. Next, we'll see how they're fueling these giant projects, what management's game plan is, and finally, we'll wrap it all up with our final verdict on the business.
Okay, first things first. What does Applied Digital actually do? You know, the AI stuff they support is super complex, but their actual business model, it's surprisingly straightforward, even though it costs a ton of money to pull off. Let's break down their core operations.
This right here sums it up perfectly. Honestly, the best way to think about them is as a super specialized real estate developer. They go out and secure the three most important things: land, massive power contracts, and all the right permits. Then, they build these incredibly sophisticated buildings. These aren't just warehouses. They are high-tech data centers. And they run them for clients who need an absolutely staggering amount of computing power for things like training AI models, running cloud services, and, going back a bit, mining crypto.
And this is where things get really interesting, because it's like looking at the company's past and its future on one slide. On the left, you've got the legacy business, their data center hosting. This is what they built the company on, mostly serving crypto miners. It's stable, it's established, it brings in consistent cash. But the real story, the company's future, is on the right. That's the high-performance compute, or HPC hosting business. This is the new frontier, all about building these next-gen facilities for the crazy power and cooling needs of AI. And as you're about to see, this is where all the action is.
And if we look at a quick status update, you can see that pivot happening in real time. The old-school data centers in North Dakota, they're humming along, totally full, providing that nice, stable financial base. But the huge news is in the HPC segment. Their first big 100-megawatt facility is now up and running. This is the first real proof that their big bet on AI is paying off. And one other key move to notice. They're spinning out their cloud services business into a new company called ChronoScale. So why do this? It's all about focus, right? This lets the main company do what it does best, build and operate these giant data centers while still owning over 80% of the new cloud platform. It's a smart move to keep things clean and unlock more value.
Okay, so now we get the business model. Let's get to the numbers. And believe me, the very first number you see when you look at Applied Digital's recent reports, it's a big one. This section is all about their top-line growth, which has been, to put it mildly, spectacular. 250%. Just let that sink in for a second. That's the year-over-year revenue growth they just posted. I mean, that's the kind of number that makes everyone on Wall Street sit up and pay attention. It tells you something big, something fundamental is changing inside this business. But a number like that always begs the question, where did it come from? Is it real, and is it sustainable?
This table tells the whole story. Look at this. Total revenue shot up from about $36 million last year to almost $127 million this year. Now let's see where that came from. The legacy data center business grew a healthy 15%, which is great. But look at the HPC hosting line. A year ago, 0. This quarter, $85 million. That's it. That one new business segment is almost single-handedly responsible for that 250% growth. It just shows you how dramatic and successful this pivot to AI has been.
And this chart really paints the picture, doesn't it? After just 1 quarter of being fully operational, the new HPC business is already 2/3 of the company's total revenue. The legacy business, still important, is now the smaller slice of the pie. I mean, this isn't some slow and steady change. This is a lightning-fast shift in what this company is, all driven by that big bet on AI. So let's peel that back one more layer. What's inside that $85 million in new revenue? This is a really important point. It's two different things. The big chunk, $73 million, is from what they call tenant fit-out services. You can basically think of this as one-time revenue for custom construction work they did for their first big customer, CoreWeave. But the second piece, that $12 million, that is the really important one for the future. That's the recurring rental revenue that started coming in as the new facility powered up. So while the big one-time payment looks great now, it's that recurring rent that's going to be the bedrock of this new business for years to come.
Okay, so revenue is through the roof. Awesome news, right? Well, not so fast. Anyone who's been around investing for a while knows that this kind of growth costs money, a lot of money. So now it's time to look at the other side of the coin, the company's bottom line. What's the real price tag on this 250% hypergrowth?
And this leads us to the central puzzle of this section. It's a paradox, really. How can a company with revenue going to the moon still report a big fat net loss according to the official accounting rules? The answer, as you might guess, is that it costs a fortune to generate that kind of growth. Let's look at the expenses.
And this table shows us exactly where the money went. Let's go through it. First, cost of revenues. This actually grew faster than revenue, up 344%. Why? Well, remember that $73 million in fit-out revenue? It came with nearly $70 million in costs. That's your answer. Next, SG&A expenses, basically corporate overhead, more than doubled. The biggest chunk of that was almost $24 million in stock-based compensation, a non-cash expense, but a real cost. And finally, interest expense, nearly quadrupled. Well, that's the bill coming due for borrowing billions of dollars to build all this new stuff. Every single one of these jumps is tied directly to this massive growth spurt.
And when the dust settles and you add it all up, this is what you're left with, a GAAP net loss of $31.2 million for the quarter. It's pretty jarring to see that right after we celebrated 250% growth. This is the official number, the one that includes everything. But it's not the only way management wants you to look at their profitability.
This slide is perfect because it shows the two different ways to look at this. On the left, you've got the official accounting loss, $31.2 million in the red. But on the right, you have a number management really likes to talk about, called Adjusted EBITDA, which is a positive $20.2 million. The gap between those two is over $50 million bucks. So what's going on? Adjusted EBITDA is a non-standard metric. The idea is to add back a bunch of non-cash or one-time expenses to try and show you what the underlying cash-generating power of the business looks like.
So how do you magically turn a $31 million loss into a $20 million adjusted profit? Well, you start adding things back. The biggest one is $28.1 million in stock-based compensation. Now, this is a non-cash expense, meaning cash doesn't leave the bank, but it's still a real cost to shareholders. Then you add back interest and taxes, depreciation, another non-cash charge, and some other one-time transaction costs. By doing this, management is basically saying, hey, if you ignore all these specific items, our core business is actually generating positive cash flow.
Okay, so we've seen the wild revenue growth and the kind of complicated profitability picture. But building these AI factories costs billions of dollars before you see a single penny of rent. So the huge question is, where is all this money coming from? For that, we got to look at the balance sheet and the cash flow statement.
Let's start with this. Wow. At the end of the quarter, Applied Digital was sitting on $2.3 billion in cash. For a company this size, that is a massive war chest. It's a huge signal that they've successfully gone out and raised the money they need to build out their dream pipeline.
But, and this is a big but, here's the other side of that story. For all that cash, they have even more debt, $2.6 billion. This right here, this contrast, is the heart of their entire financial strategy right now. They have taken on a mountain of debt to fuel this expansion. They are betting big, and they're using leverage to do it.
So how on earth did they raise all this cash? It wasn't just one thing. The biggest piece was a monster $2.35 billion private debt deal. On top of that, they pulled down over $500 million from a specialized financing deal with Macquarie, a huge global infrastructure investor. And they also sold almost $200 million in new stock. They are literally pulling every financial lever they can, debt, preferred equity, common stock, to pile up the billions they need to build.
You know, the cash flow statement tells the real story, plain and simple. And this is a classic growth at all costs picture. First, cash from operations was negative $98 million. That means the day-to-day business is losing cash. Second, cash from investing was a huge negative $818 million. That's basically all the money they're spending on construction. So if you're burning cash in operations and burning even more on investing,
Where does the money come from? Look at the last line. Cash from financing was a positive 3.1 times billion. This shows clear as day that every dollar they have is coming from outside investors and lenders. And if you want to boil it all down to just one number, look at this. Free cash flow, which is just your cash from operations minus what you spend on construction, was negative $899 million over 6 months. That is the definition of cash burn. It confirms the entire model right now is totally dependent on that outside capital they just raised. Okay, that's the story so far. We've looked at the performance, the costs, the financing. But what about tomorrow? What's management's game plan? What's the super bullish case they're selling to investors? And what are the risks they're admitting to?
And here is that bull case. The numbers are just wild. The company has already locked in long-term contracts for 600 megawatts of capacity. This isn't just a hope or a dream. These are signed deals. And the total value of those contracts over their lifetime? $16 billion. It's anchored by 2 monster deals, an $11 billion deal with CoreWeave and a $5 billion deal with a new, unnamed but very important, investment-grade U.S. hyperscaler. This backlog is why they can now set a new incredibly ambitious target to make over $1 billion in net operating income a year within 5 years.
And according to the CEO, this might just be the tip of the iceberg. This quote basically says that success is breeding more success. Now that they've proven they can deliver for 2 big players, everybody else wants to talk to them. He even mentions they're in advanced discussions with another big hyperscaler. This is the core of the bull story. They believe they can just keep doing this over and over in a market that is starving for this kind of infrastructure.
Of course, that's the sunny side of the street. Any plan this big has some serious risks, and they're pretty open about them. Number 1 is just execution risk. It's one thing to sign a contract. It's another thing entirely to build these incredibly complex facilities on time and on budget. Number 2, financing risk. We just saw it. The model is 100% dependent on outside money. If that money dries up or gets more expensive, their plans could be in trouble. Third, customer dependency. Their entire future is basically riding on 2 customers right now. If anything goes wrong with either of those relationships, it's a huge problem. And finally, you've always got supply chain and power grid risks. These are the big hurdles they have to clear to make that $16 billion dream a reality.
All right, we have looked at this thing from every angle. The business, the profits, the cash, the future plans. Now it's time to put it all together, to synthesize everything into one cohesive verdict on what's really going on with this business.
And to do that, we're going to pull out a really cool analytical tool. It's called the Self-Sustainable Growth Rate, or SSGR. Basically, what this metric does is calculate the fastest a company can grow using only its own money, without needing to borrow or sell more stock. It's a fantastic way to measure how strong and resilient a company's business model really is. It cuts through all the noise and tells you if a company can fund its own destiny.
Now, let's quickly look at how the sausage is made here for Applied Digital. The formula has a few parts, but the most important one for our story is that second line, NPM, or net profit margin. This just asks, for every dollar in sales, how much profit is left over at the end. And as we saw, because they had a GAAP net loss, their profit margin is negative 21%. When you plug that negative number into the formula along with the others,
you get this, a self-sustainable growth rate of negative 8.4%. And that single number, right there, is the key to understanding this entire investment thesis at this very moment.
So what in the world does a negative SSGR actually mean? It's profound. It means that based on its current profitability, the company cannot fund any growth on its own, not 1%. This mathematically confirms what we saw in the cash flow statement. That incredible 250% revenue growth isn't just partially funded by outsiders, it is 100% funded by the debt and stock they sold to investors. The business, right now, has no internal growth engine. All of its fuel is coming from the outside.
And that brings us to our final verdict. We're classifying Applied Digital's business model as improving. Now why? For 3 key reasons. First, the growth is absolutely explosive. And even better, it's contractually secured. That $16 billion backlog is real, providing a clear path of future revenue. Second, they have proven they can get the money. They successfully raised the billions needed to build, which is a huge vote of confidence from the market. But third, as the negative SSGR proves, they are completely reliant on that external money. It's a classic high-risk, high-reward construction project. We say improving because they are nailing the first 2 critical steps of their plan. They won the customers, and they raised the cash. Now it's all about step 3.
And that leaves us with this one last critical question. They've done the hard part of winning the deals and raising the capital. The path is laid out in front of them. The challenge now is pure, unadulterated execution. Can they build these incredibly complex AI factories on time, on budget, and turn that mountain of debt into a powerful, sustainable stream of cash flow? And maybe just as important, can they do it before the cost of borrowing money changes? The answer to that is what will decide if they truly capture this once-in-a-generation opportunity.